Welcome to the Investing Show. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King
Simon.
and Colin McLean of SVM Asset Management. Welcome to the show.
Thank you.
Colin, we hear talk all the time about how the world around us is changing dramatically for consumers with technology and changing behaviour. And I think it's difficult for investors to get a handle on quite how important that is for them, because obviously we see these changes not as a sudden big bang, one morning you wake up and Uber suddenly exists, but as a much more gradual process. How important do you think getting a grip on this kind of stuff is for investors in terms of making money in the future?
I think it's very important. It's going on all the time, and in ways that we maybe don't often see. Technologies becoming embedded in new services. The new disruptors are maybe not covered or getting headlines, so we don't really see what's chiseling away until we get some surprises. A company will come out with a disappointment. We've seen a few of those this year, and suddenly you find that some of their core business is gone.
So it's not just about technology, companies that in fact that are coming out with new technologies, the sort of big disruptive names that we hear about all the time, the Ubers of this world. It's actually more about how the companies that we know and perhaps love and have seen for many, many years are actually dealing with the technological change, but also consumers changing their behaviour as well.
Yes, I mean, people talk about the younger people, millennials, and how much they are unwilling to own property, buy houses, buy cars, and indeed how little respect they have for some of the long-established brands, the consumer brands, maybe like Heinz and so on, don't carry as much weight with them. So, and they're much more into experiences. So we're finding changing behaviour that just means some of the blue chip, long-established names just don't have it so easy anymore.
Is there also an element that perhaps the older generations think of technology stocks in the sector over here and everyone else over here, whereas the reality is that the vast majority, if not all of companies these days, have technology fairly much at their heart?
Yes, and a lot of companies are being quite good at implementing, even something like Ryanair, which should win as a low-cost producer, but it's also now realising it's got lots of data it can use much better and use much better with customers. So there's some companies that are really just starting now to catch on to the data. There's one or two of the challenger banks have been very good at using the data to work out what credit should be rated. This is something that's taken the traditional banks years in the high street of seeing bank managers to understand credit, but they've used this data in a way that they can undercut and enter new segments.
And that question of using data, I think, is an interesting one, actually, because I think for many of us, there's a concern about that data and how it's used. The classic being followed around the internet by an advert for a product that you looked at once. Something a former colleague of mine used to call the stalking drill bit, as in you looked at a drill bit once and then the drill bit followed you around the internet. And I think that because we have a concern about that kind of thing, there can be a tendency perhaps to shut off when we hear talk of data and how it can get much more into the consumer's minds and things like that. We go, oh, I don't like that kind of thing. But that is really important, isn't it, for companies moving into the future? And as an investor, how can you look for the kind of company that's using that stuff well?
I think the data, even when we don't realise it, is being sucked up, and we grant people access to our location or our data if we think it adds some value to us and it's some use, and in that way they do get hold of it. I think we need to listen to the companies and find out what they are actually doing with this. I think some like Ryanair have explained what they're doing, some of the challenger banks have explained that. And I think we also need to ask some of the traditional companies much more if they are showing, particularly some of the high street retailers, that maybe they're not making any progress in sales. We need to get to the real underlying reasons for it. Some of it is disruption, not just a seasonal thing, which is sometimes the way they excuse it. So I think we need to get to the root of what is driving businesses and whether they are being disrupted or whether they're making good use of data and finding an edge.
And does that mean a bit of old-fashioned digging into the company report and the results and the trading updates? And because it's not necessarily the thing, if they've done something well, then, or they've got something they want to shout about, then a company might be putting it in the bullet points at the top of the trading update or the half-year results or the annual results. But quite often that stuff is buried a bit further down, isn't it? And you have to go digging for it.
Yes, and I mean some of the new entrants, some of these disruptors are not household names, so they're not getting headlines. So we need to be alert to new services that are coming along. For the traditional, incumbent companies, yeah, they often cover it up or maybe flatter the results. So we're seeing companies perhaps that have been facing disruption for a while, and we can only maybe look back to those companies, maybe like HMV, and we saw that records were disappearing. Now CDs are just disappearing, but it took years before it finally disappeared, and meanwhile we get lots of stories about how they would deal with it and so on. So we just question the stories perhaps that come from, for example, high street retailers, and find out whether there's something really fundamental. And where we see a new entrant coming in, I mean Amazon now with its fresh food selling and so on, these are huge disruptive potential, and we need to be very alert to just what progress that's making, because it will be taking someone else's lunch away.
Presumably you sort of, obviously you're talking about the wider view largely now, but in terms of sort of zooming in on more specific companies, you're always going to have the one man or indeed woman and his dog with just one app, for example, which could be very disruptive, but at this stage isn't really appearing on the radar. And obviously with that, from an investment point of view, carries a lot more risk. So where do you pitch the sort of potential investment opportunities you might be looking for or indeed finding?
I mean, I think for private investors, they can cover some of that with a spread. I mean, there are some funds that specialise in technology or some of the newer businesses, so they can get that sort of a spread. And of course, it's harder for investors in the UK to buy into the big American groups. But there are some very interesting British companies coming along, ones like Sophos and cybersecurity. So there are some names here that are interesting, and I think if people look out for companies that seem to be doing interesting things and ones they come across, there's a lot of companies developing apps. There's only so much space, that real estate on your phone is precious, and you can't just load up lots of them. So there's just going to be a few winners who it may be someone like Ryanair is really going to put everything into that. So we need to look for who's getting that space. The real estate is not in the high street. This is not just about technology. It's much more about the mobile revolution and really what gets onto your phone and the apps that seem to be useful there. So the winners will be the ones that really earn that space on our phone.
And that shines through in some of the retailers, doesn't it? It's the ones that have done really well with technology are the ones who have made it easy. It's not necessarily all singing and all dancing and the fanciest thing that you've ever seen, but it's quick, it works, and you get what you want at a time that is convenient for you, whether that's collecting it in store or having it delivered to you. And it's about, I think, maybe looking at that process and putting yourself not into the shoes of the customer, isn't it? Going, well, if I'm a customer, what do I want here? And who's doing this? Which clothing retailer is doing this well? Which high street retailer is doing this well? And which is doing it badly? I mean, that was one of the key things behind Sainsbury's acquisition of Argos, wasn't it? Was because they looked at Argos and went, Argos has done this click and collect thing very, very well.
Yes, some are much better than others, and I think we probably all have had experiences of the ones that haven't worked and the ones that do. I think for people entering now, yes, it's quite late to get all that joined up, get the clicks and mortar thing working. I think there's a lot on the high street really are going to struggle if they haven't got there already. They're going to struggle. Yeah.
I mean, innovation as well isn't just about technology, is it? It can be about products as well, and you can have a product that you come up with that just taps into either a gap in the market or a changing taste as well, can't you?
Yes, I mean, a very interesting example is Fever Tree Drinks, which entered a very old market. Mixers realised there was a particular interest in gin and growth in that, and also from many people really wanting to look much more at experiences and really look for a quality or crafted product. So alongside that growth in craft gins, they developed a new premium segment and went about it in a very capital light way, in which they didn't have to tie up a lot of money, but contracted it out and really just worked on the brand and the structure of the business model rather than making it themselves. and they suddenly, they got that first mover advantage and have grown to be a £2.5 billion company now.
Seems so obvious when you look at it, doesn't it? The Fever Tree thing. You think this was so obvious. Why didn't I think of that?
Well, it's not unlike the explosion we've had in craft beers as well. We've even a very small company like Greenwich Meantime got brought up by one of the really big boys recently, and it's interesting you should mention whether the craft beer explosion we're seeing is now entrenched, or whether that's another trend that might wither.
Yes, it'd be interesting. I mean, we've had decades in which the number of pubs grew and the number of breweries fell, and we've now suddenly been through a decade in which the number of breweries is, admittedly very small ones, has grown. I think there is a pattern there which we're seeing with the behaviour of younger consumers and millennials, and which is much more focused on experience, very selective, valuing much less traditional brands, and looking for genuine service or added value with our brand as well. And there's lots of edges around. We were talking, before about new credit cards that are very cheap on exchange rates, cheap to use abroad, and that's an area where banks take quite a big turn, as we know, if we go abroad and find currency conversion afterwards charging us quite a bit. So there's particular pockets of opportunity, I think, that new entrants without a brand have gone for, because the consumers are ready and willing to hear someone that will make buying goods abroad fairer, cheaper.
Presumably, one of the other things we need to bear in mind with the millennials is that with the best will in the world, throughout their 20s, for example, disposable income could be a problem on the basis perhaps a young family, perhaps a new mortgage or not, perhaps repaying a student debt. The fact is, that's quite apart from the fact that they're becoming more aware of saving early for their eventual retirement as well. So I guess that's another delineation when you're looking at these companies, that disposable income tends not to kick in until you're sort of maybe mid-30s onwards.
Yes, there's probably not the same disposable income, but where that income is going is definitely different than previous generations, and it's giving opportunities, I think, for new entrants just to tap into what particular services, things they want, and maybe just gear, particularly if someone say enters on a financial technology, some new fintech product, just tackle something that makes it look very simple and very easy for people. So I think there's a market there that's increasingly going to be more important. I would worry about established businesses if they're not capturing even that lower spend of people in their 20s or 30s. As that group matures, they're really going to have missed a market.
So in essence, it sounds almost a bit more like, rather than being a sort of, you've got to wrap your head around all this new technology, you've more got to think about the element of quality over quantity, and that people are going for quality, and once they get quality that they like, it's a bit stickier than the old-fashioned pilot high, sell it cheap model.
Yes, I think that would cover a lot of this, and I think Fever Tree is just a very good example of the sort of business we're going to see in future, that can be backed and probably travel for a lot further than we ever would have imagined. Can get to be a much bigger company than we would have thought. There'll be more of these coming along, and I think we'll get some more surprises from what we think of as blue chips, who just suddenly find that they don't have an edge anymore.
Colin, thank you very much. That's all we've got time for. Richard, thank you very much.
Okay.
Thank you very much for watching. Join us next time on The Investing Show. Goodbye.